So for 35, chapter 7, it gives you pretty much everything, and then you have the equation where you solve for x. So these three are given, and there's x, and then you just plug it into your...
Yeah, and could you just read the problem so that we can follow along?
Okay.
And then what I would do if I were you guys is I'd be filling out the extra credit problem set right now since you already have the solutions. So as they're going through them, I'd be writing out the answers and then just finish the extra credit problem set problems that haven't been done, and boom, you got extra credit you're looking at today.
All right.
Sorry, didn't mean to interrupt.
No, Barbara purchased a piece of real estate last year for $85,000. The real estate is now worth $102,000. If Barbara needs to have a total return of 25% during the year, then what is the dollar amount of income that she needs to have to reach her objective? So we have the price now and the price before, and divided, or plus x divided by the price before, and we get 0.25%. And we solve for x right here, and that equals 2,250, or 4,250.
If you could show me the mathematical proof, you know, on the extra credit and on the exam, that would be awesome. So I can know that you know how to do algebra.
Okay. And then for 95, Noelle is planning to invest in an insurance company product. The product will pay $12,500 at the end of this year. Thereafter, the payments will grow annually at 2.5% rate forever. Jack will be able to invest his cash flows at a rate of 5.5%. What is the present value of his investment cash flow stream rounded in US dollar? So we have a bunch of givens. We have cash flow, which is 12,500, annual growth rate, which is 2.5%, discount rate, which is 5.5%, and we're trying to find the PVA. So we plug in the CF1, which is 12.5 or 12,500 divided by the annual growth rate and the discount rate subtracted by each other, and we get 416,666 and 67 cents. And on 99, Cosmetics borrowed $152,300 from a bank for 3 years. If the quoted rate APR is 11.75%, the compounding is daily. What is the effective annual rate rounded to the nearest decimal? So we also have a bunch of givens. We have the loan amount PV, which is $152,300. Investment rate, which is I, is 11.75%. Frequency compounding M is 365, and we're trying to find the effective annual rate. So we have our equation right here, and then we plug in the interest on the loan and the frequency compounding, and here's our math. We get 12.5%.
Thank you very much. Doesn't need to be close. And then who's team 6? Jeff, you know?
So this is chapter 9, start with problem 60. Zenua Manufacturing Company has been generating stable revenue, but sees no growth in it for the foreseeable future. The company's last dividend was $3.25, and it is unlikely to change the amount paid out. If the required rate of return is 12%, what is the stock worth today? So the dividend, it starts at $3.25. The required rate of return is 12%. So you just plug these in right here, 325 over 0.12, which is the 12%, and then you come out with $27.08. And then 61, communications company pays annual dividends of $8.50 with no possibility of it changing in the next several years. If the firm's stock is currently selling at $60.71, what is the required rate of return? And so this is what it's currently selling at, $60.71. No chance of change. The dividend is $8.50, and so you just plug it in here, dividend over R, and so it's $8.50 over $60.71. Come out with 14%. 63, Johnson Corporation has just paid a dividend of $4.45. The company has forecasted a growth rate of 8% for the next several years. If the appropriate discount rate is 14%, what is the current price of this stock? And so this is just doing it the other way. So the dividend is $4.45. The growth rate is 8%, and the discount rate is 14%. So you just plug these in here, and so you get the $4.45 times the 1 plus the 8%, so 1.08, divided by the 14 minus 8, and so then you get 486 over 0.06, which comes out to 80, rounded to the nearest dollar. And then 77, Biocide Inc. is a biotech firm, has forecast the following growth rates for the next 3 years: 30%, 25%, and 20%. The company then expects to grow at a constant rate of 7% for the next several years. The company paid a dividend of $2 last week. If the required rate of return is 16%, what is the market value of this stock? And so these are the growth rates for the next years: 30%, 25%, 20%, and then it expects it to grow at 7% after that. And the dividend they paid out was $2, and the required rate of return is 16. And so you'll start with the original $2, and then at 30% becomes $2.60, and then the next year $2.60 is the additional 25%, and then $3.25 is the next 20%, and then you do it by 7% after that. And so you do that, and you put after the first year, it's right here, 260 over the 116, and then 325 over 116 squared, and then after that it's 390 plus 46, 37 over 116 cubed, and you come out with 224 plus 242 plus 3220 equals $36.86.
Excellent. And just remember, you have to grow that out to a 3-year holding period. So you got to grow out the dividend 1 more year to D4, and then you apply the Gordon growth model to that to get the terminal value, and then you add that to the 3rd-year cash flow, and then discount it all back to the present. You get that? So you just have to remember that you have to grow this out 1 more year. So your holding period's 3 years. You grow it out 1 more year. And then you apply the Gordon growth to get the terminal value. And then you add the terminal value to the 3rd-year cash flow. And then you discount it back to the present value. That's the trick. Okay? Okay.
So for 71, you invested $3,000 in a portfolio with an expected return of 10% and $2,000 in a portfolio with a expected return of 15%. What is the expected return of the combined portfolio? So you're going to take the 3,000 of the first portfolio and divide it by 5,000, which is the 3,000 and the 2,000 combined, and then multiply it by the 10%, and then add the 2,000 over 5,000 times the 16%, which will get you 0.124, which is 12.4%.
All right, for problem 74, given
the returns for two stocks with the following information. Calculate the covariance of the returns for the two stocks. Assume the expected return is 14.4%, and for stock two it's 15.9. And to get the covariance, which is this is the answer, you multiply the probability and you subtract stock one from the percent and stock two from its percent, and you multiply it through and then do out a multiplier to get that. This one.
For 76, this is the covariance of the returns between stock A and stock B is 0.8.
Is it the covariance or the correlation?
The covariance. Well, we're looking, well, I was reading the question.
Okay.
Oh, sorry.
No, that's okay.
Well, the question is, what is the correlation coefficient between the returns of the two stocks? So here, we take the covariance of the returns, which is 0.0087, and we divide it by the standard deviation of stock A and stock B, which is here, and they're multiplied by each other. And so you find the correlation coefficient by multiplying these two and dividing it by the covariance is 0.09047.
So is it correlated? Are the returns correlated? You round this up, what's the percentage?
9.
10%. So 10%. Is it positively, negatively correlated? Is it negative or positive correlation? Did they move together, or did they move in opposite direction? Or did they move slightly with each other? Positive or negative? Positive. Okay, so they move together. Got it. Is it a strong correlation or a weak correlation? Weak. Because what's the range in percentages? Yeah. Plus 100% or negative 100%. So is it moderate, strong, weak, weak? Excellent. Okay. Team 5.
So for chapter 7, number 77, the p-value equals the covariance of the Wildcat stock and the Sun Devil stock over the variance of the Wildcat and Sun Devil stock. So the covariance is 0.09875 over the square root of the variance of the two stocks, which is 0.2116 times 0.1369. That equals 0.580199. And for 83, the expected return of the Elsinore stock equals the return of the risk-free return rate plus the beta of Elsinore multiplied by the expected return and minus by the risk-free return rate. So that all goes to 0.08 is the expected return of Elsinore plus 1.6 multiplied by the difference of 0.15 and 0.08, and it equals 0.192, 19.2%.
And then what equation is this? 83. What equation is this? What are they using to calculate the expected return? Test question. What's this called? Test question. This is the other one you need to memorize too. Okay. Anybody know? You're going to see this a lot. The capital asset pricing model. Tell my students that you need to tattoo 2 equations on yourself, actually 3. You should tattoo on one of your ankles the Fisher equation. On the other one, you should tattoo the capital asset pricing model equation, and then somewhere else on your body, you should tattoo the weighted average cost of capital so you never forget it. Go ahead.
And then chapter 8, problem number 38, the question is, Briar Corp is issuing a 10-year bond with a coupon rate of 7%. The interest rate for similar bonds is currently 9%. Assuming annual payments, what is the present value of the bond? So the years to maturity is 10 years bond. Coupon rate is 7%. The annual coupon, we're going to take $1,000, multiply it by that 7%, we get $70. And the current market rate is 9%. That's all information that's been given to us so far. So we're trying to find the present value of the bond. And that would be this equation up here. Try and study this way. And then you can take it down a step further. This next equation, and then you just plug it in. If you guys can see it, it's pretty small. If you guys want, you can come up and take pictures of it. Then once you do the math, we get $871.65. But don't forget that it says to round your final answer to the nearest dollar, so it's $872. I'm assuming a question like that's going to be on the exam, where you need to pay attention to the sense of the end.
Is the bond, test question, is the bond trading at a premium, par, or a discount? Is it trading at a premium? I think I said this like 100 times last class. Is the bond trading at premium, par, or a discount? It's like a sing-along. This is finance sing-along. So everybody. Discount. Excellent. Okay. If you did the calculation and you came up with $1,000 as the price of the bond, would it be trading at a premium, par, or a discount? Par. Par. Got it. And if it was over 1,000, would it be trading at a premium, par, or a discount?
Premium.
Premium. Got it. And when it's trading at a premium, the bond is trading at a premium. Is the coupon interest rate higher or lower than the market rate? I'm just trying to get everybody. You're on fire. So I can't even I gotta cool you down. Put some fire extinguisher on you. If the coupon interest rate is higher than the market interest rate, does the bond trade at a premium, par, or a discount? If the coupon interest rate is higher than the market rate, is the bond trading at a premium, par, or a discount? If the coupon interest rate, the coupon rate on the bond is higher than the market, would the bond be trading at a premium, par, or a discount?
Premium.
Got it, premium. Because the coupon's paying a higher rate than the market. So it'd be trading at over $1,000. Okay. And if the market rate is higher than the coupon rate, then the bond is trading at a discount. Okay. So you need to memorize that logic. Okay, thank you.
I have a question. And if they trade the same, it's par?
Yeah, if the coupon rate and the market rate are the same, then it would be $1,000 and the bond trades at par. And most corporate bonds are $1,000. Okay.
So for in chapter 9, question 58, Givens Inc. is a fast-growing technology company that paid $1.25 dividend last week. The company's expected dividend growth rates over the next 4 years are as follows: 25%, 30%, 35%, and 30%. The company then expects to settle down to a constant growth rate of 8% annually. If the required rate of return is 12%, what is the present value of the dividends over the fast growth phase? Well, the fast growth phase would be the first, the next 4 years. After that, it would go back down to 8%, right? Okay, so the first year, zero is the year zero of the dividend, $1.25, and then calculate the next year, it's D0, or the year before, times 1 plus G, and G is that growth percentage, so that first year would be 25%. That's why we have $1.25. The next year is 30%, 35%, 30%. That's how those are reflected. To get this first number, you take the number of the year before, and you're going to go over here with your present value of the dividends equation. You plug it in of that year 1 over the required rate of return is 12%. That's the required rate of return. But it needs to be greater than 1, otherwise you're going to get the wrong answer. So it's 1 plus the rate of return. And then year 2 is going to be squared. Year 3 is going to be cubed. And year 4 will be you take to the fourth power. You're gonna go in, you're gonna solve these, the numbers you get, and you add it up, and you get $7.23.
And that's
the
just,
present value of the dividends.
yeah, that's just the present value of the dividends. If you were gonna get the market price, you'd have to grow the dividends out one more year to the fifth year, and then apply the Gordon growth model to get the terminal value. And then you would have the terminal value for the fourth year's dividend, and then discount it all back to get the intrinsic value of the stock using the discounted cash flow method. Okay, nice job, guys. Thank you.
So for here, we need to find our chapter 3. Back in the pamphlet, we need to find our quick ratio. To find that, we are given our current assets of $62,122, and our current liabilities are given as well of $378,454. And then from there, we also have our inventory of 241,990. It gives us the quick ratio. We take our current assets of 623, and then we minus it from our inventory, and we divide that by our current liabilities, as you can see right here, algebra, and then we get 1.01. Down here we have, and then we move to chapter 4. We have 66. We have cash flows from investing activities of 14,215. And then we have our cash outflows from investing of 36,845. And then to find from there, we add up the investing activities of 109,455 to get 146,300. And then from there, to find our net inflows, we take our net cash flows, we take what's coming in and what's going out, and we minus them, and then we have negative $132,085 for net cash flows used in activities.
All right, and then chapter 4, problem 60. Your firm has an equity multiplier of 2.47. What is its debt to equity ratio? So your equity multiplier is 2.47, as was stated. The equity multiplier equals 1 plus debt to equity, and then you do debt to equity to find that. It's going to be your equity multiplier minus 1. You already know it's 2.47, so you minus 1. Your debt to equity becomes 1.47. All right, and then you want to do 63.
Okay, so 63, RTR Corporation has reported a net income of $812,425 for the year. The company's share price is $13.45, and the company has 312,490 shares outstanding. Compute the firm's price to earnings ratio and rank okay, so they give us net income, share price, shares outstanding, and then they want us to find the price to earnings ratio. So to do that, we just have to divide net income by the shares outstanding, which was about $2.60 per share. And then we take the share price divided by that answer we get, and it gives us 5.17 times.
Great, thank you. So that's your price earnings multiple or multiple. Thank you.
Is that a high number, 5.0?
Usually and you might want to write this down as a benchmark, is most established firms, large established firms, will have a multiple of 8. 8 is like the benchmark. So if it's 8 times earnings and that's trading at 5 times earnings, what are the growth prospects of this firm? Higher or low? Lower, yeah. And then what if some of these tech companies are trading at 100 times earnings, maybe even 1,000 times earnings? What are the growth prospects for those startup companies? Extremely high, extremely high, exactly. And that's what they normally use, is the multiple approach. And we'll get into applications around the multiple approach as we move into the application section of the class. So I had chapter 5, page 116, number 89. Fenord Traps Manufacturing an innovative mouse trap. Total sales for the current year is $325,000. The company expects its sales to go up $500,000 in 5 years. up to 500,000 in 5 years. What is the expected growth rate in sales for this firm? So we have the 500,000 we're trying to solve. The current sales is 325,000. If we were the growth rate factor, the growth factor, or the future value factor would be 1 plus g to the 5th. So what we do is we do some algebra. We bring the 1 plus g to the 5th over here, and then we rearrange it. 500,000 divided by the 325,000 is going to give us 1 point. And this is what I love about the block, is it's going to give you 1.538461538. Do you got to go out 9 decimal points?
No.
Probably not. So I'm not really sure why they do that. So then we have the growth factor. We have basically the 1.54, and then we isolate the g, bring that over, take that to the 1/5 minus 1 is going to give us an 8.99 average annual compound growth rate over the 5-year period. So basically 9% per year. For 91, Manufic, a detergent manufacturer, has announced this year's net income as $832,500. It expects its net earnings to grow at a rate of 15% per year for the next 2 years, before dropping to 12% for each of the following 2 years. What is the firm's net income after 4 years? So basically we set up the future value factor, which is for the 4th year, present value times 1 plus g squared plus 1 plus g2 squared. So it says that the 800 and this year's net income of 832,500 is going to grow at 15% for 2 years, so it's 1.15 squared, and then 12% for another 2 years, so it's 1.12 squared. So then you just get the multiplication factors and the future value factors multiplied together, and you get $1,381,071. The next one is 100. Omniva Inc. just generated earnings per share of $3.75 for the fiscal year ending September 30th, 2014. The firm is expected to achieve earnings per share of $8.76 in 5 years. At what rate will Omniva Inc.'s earnings per share be growing over this 5-year period? So what you would do is they want to know the rate of return right here. So you know that the future value is $8.76. The current is $3.75. You take that to the 1/5 minus 1. Okay, it's going to give you this factor minus 1, 18.49%. Now this is the average annual compound growth rate. You need to memorize this equation. You're going to be using it all the time in anything you do. So you have to be careful. You have to be confident in your ability to be able to calculate average annual compound growth rates. You just can't take the percentage change over a 3-year period and divide it by 3. You can't do it. Okay, it's wrong. So you got to be able to calculate these average annual compound growth rates and be comfortable with it. Okay. And again, I'm telling you that not because I'm coming from teaching you from the book. I'm telling you because this is the stuff I do all the time as an analyst. Okay, so who's got chapter 3? And don't forget to give me back these templates. You know, at the end, because they're already posted up on the website, and I want to use these for the next sentence. Okay, thank you.
All right, so
Sorry, I cut you off.
Number 56, Centennial Brewery produces revenues of $1,145,227 in 2008. It has expenses including depreciation of $812,640, depreciation of $131,335, and interest expense of $81,112. It pays an average tax rate of 34%. What's the firm's net income after taxes? Round your answer. So what I did was I took, or in the equation, you take the revenue and you subtract it by all the added expenses, and you come out to the net income of 120,140. And then you take that and you multiply it by the 34% tax rate. You subtract that by 1, and you come out with the answer of 79,232.
So your after-tax net income.
Yeah.
Got it. Thank you.
It's chapter 3, number 44. Maddox Inc. has completed its fiscal year and reported the following information. The company had current assets of $153,413, net fixed assets of $412,331, and other assets of $7,822. That all adds up to total assets of $573,566. They had total liabilities. Right here, current liabilities was $65,314 plus long-term debt, which is $178,334. That gives you $243,648 of total liabilities. And then the formula for total stockholder equity is total assets minus total liabilities, which is $573,566 minus $243,648, which gives us a stock equity of $329,918. Then you take this number right here of total stockholders' equity, you subtract common stock, 162,000, and it gives you retained earnings of 167,918.
So the 162,000. What did that say?
That's the common stock.
That was the payment to the common stockholders.
Yeah.
Okay. So this is your payout. So there might be a payout ratio. So usually it's a percentage that you multiply. That's the dollar amount that you pay out. That's the payout ratio. And then this is the retention, right? Or this is the retention. So you can get the retention ratio. 1 minus the payout ratio. 1 minus the payout ratio equals the retention ratio. Retention ratio is going to be your retained earnings. So your earnings, right? Earnings times the payout ratio is going to be the amount you pay the shareholders. 1 minus the payout multiplied by the earnings is the retained earnings. So that's another way of looking at it. That'll be on your CFA exam, and for you accountants, that'll be on your CPA exam. A lot of the stuff will be on your CPA exam. Thank you.
So I looked at the wrong 48, so I looked at the one in chapter 4. So this is the chapter 448.
Okay.
But I can just read out from
Yeah, go for
chapter 3.
That's fine.
So the total current assets would be the $335,485 plus the $1,488,121 plus $1,651,599 plus the other current assets, and then that will be equal to the total current assets of $3,596,632, and then the total current liabilities would be the accounts payable plus the short-term notes payable, which would equal $1,473,020, and the net working capital would be the total current assets minus the total current liabilities, which would equal $2,123,612.
And then were you going to present that one too?
Oh, for chapter 4?
Yeah, was that yours too?
No, I looked at the wrong 48.
Oh, that's okay. Do you want to present that one too?
Okay. So this is the current assets. It's cash plus inventory plus receivables, which equals $859,140. And this is current liabilities, which is just the accounts payable. And then the current ratio is current assets over current liabilities, which equals
So do they have enough current assets to cover the current liabilities?
Yeah.
Yeah, like 2 times.
Mhm.
So that's pretty good.
Yeah.
Thank you.
Alright, so chapter 6, number 66, it says Damian McCoy has loaned money to his brother at an interest rate of 5.85%. He expects to receive these amounts each year in return for his 4-year loan. How much did he loan out to his brother? So basically what you do is you would place the amounts that he expects to receive for each year on the top. And sorry, I kind of did it downwards because kind of squeezed over here. And then the bottom, it would be 1 plus the interest rate, and then to the exponential value of whatever year it is. So for the first one, I didn't put 1, again, because it would just be 1, which doesn't change the bottom. But for the second year, it would be squared, third year, cubed, fourth year, to the 4th power, I'm not really sure what that is. And then if you add all of them together, you would get $3,657, which would be the full loan to his brother.
And then does it ask about the payback?
No, it does not.
Okay.
Alright, so number 71, it's basically asking about what the present value of the investment is. The company's making an investment of $37,250 each year. The interest rate is or the required rate of return is 15%, and this is over 5 years of 5 payments. And this sets up probably up the required rate of return. And this is the equation right here. It's -1 minus 1 over basically 1 point, or basically over the required rate of return to the 5th power for the years, and then that's over 15%. You do that, you come out with 37,000, or then you multiply that by 37,250, and you get 124,867. And then this other problem, 72, is pretty much the same thing. We have different numbers. Let's see. You go through the same equation. You multiply that number by your investment of 11,700, and you get 110,721.
Thank you.
So this is number 67 in chapter 3, and you're given the financial results of Tier Corporation, and you're asked to find the gross profit margin and the operating profit margin. And the equation is basically net sales minus cost of goods sold, which is the gross profit, divided by net sales. And you just plug in the given information, and you'll get 34.68%. So this gives you an idea of how well the company is doing and how much money is left over in proportion of the incoming revenue. And the operating profit margin is just the interest before, or the, earnings before interest and taxes divided by the net sales, and you'll get 32.62%.
These numbers are pretty discrete, you know, in that you have nothing to compare them against. So what you'll be doing later on at the end of the class is you'll be comparing these to a direct competitor, and then what you do is you calculate a weighted average of these gross profit and operating profit margins and compare those against the peer group, okay, to really see the strength of the company's financial ratios.
Okay, number 68, chapter 4, they give you the debt, the total assets, the sales amount, and the net income, and they want you to find out what the firm's return on equity is. So you take the assets and you subtract the total liabilities, and that equals the total equity, and then you divide that by the, or you take the net income and then divide that by the total equity, and
And that gives you the return on equity, the ROE. What's the other way that we could calculate return on equity? Isn't there another method? Isn't there another method that we went through? Not today, but in the book.
The return on assets times the equity multiplier?
Yeah, it's the DuPont method. Okay, so that's one way to do it. The other way to do it is to do it through the DuPont method too. Okay, just so that you know. For you CPAs and CFAs, you'll need to know.
So the question for chapter 5, number 46 is saying there's like a person received inheritance, which is 35,775, which is like I put it as a present value, and then he plans to invest in the fund, and then if he can earn 4.75% per year with quarterly compounding for 32 years, how much will he have accumulated? So now you need to calculate the future value of it. So for the present value is 35,775, which is the inheritance, and then the I is interest rate, and the interest rate need to divide it by 4 because it's quarterly compound, and then divided by 4 because it's quarter, and then for the period part, to the power is because it's 32 years and it's quarterly compound, so it's times 4, and this is how the whole equation works, and that is the future value.
It doesn't look like a lot of money. It doesn't look like a lot of money, but imagine if your parents gave you $350,000 and you could get 4.75% rate of return annually for the 32 years. You'd be sitting on maybe 1.6 million. At the end of the time period. Can you live off that? Could you live off 1.6 million? You retire at 60? Probably not, but you could probably have a lot of fun with the 1.6 million, couldn't you? So ask your parents to give you $350,000 today. Especially when you go back for Thanksgiving dinner. It's over the pumpkin pie. You just go, by the way, Professor Souza asked me to ask you, you would give me $350,000.
Can you be on the call with me?
Yeah, I'm more than happy to.
All right.
So for chapter 7, for number 42, we're trying to find the expected return from an asset. So basically for this problem, you would just multiply the return with its corresponding probability. So this would be the returns would be 0.1, 0.2, and 0.25. And then you multiply it by the corresponding probability with 0.25, 0.5, and 0.25. And that would give you the answer of 0.1875, which is 18.75%.
Okay, for question 65, you're looking for basically the standard deviation of a portfolio. So this is the equation, and basically you just plug in each number to the respective equation. And
what's the term on the end?
Excuse me?
What's the term on the end? What's that factor, the very last factor at the end?
Okay, so then
the very last one in the variance equation for the portfolio. What's the very last? It looks like a P or
P.
What is that? Can somebody? Do you know what that is?
Okay, yeah, it's the correlation coefficient.
Got it.
And so then you get the answer, and then you just square root, and you get this.
Is that the expected return or the standard deviation? Is the 5.566?
Yeah, this is the final one.
Oh, okay, got it. Okay, got it. So you got the variance, and then you take the square root of the variance, and that gives you the standard deviation.
Yeah.
Correct? Yes.
And then on the last question, 69. You also need to look for the expected return of the portfolio, and you just basically multiply everything, and you get a final percentage of 16.8%.
What's the 0.4?
The 0.4 is the 40% of the portfolio in an investment.
Oh, so that's the weight?
And then the total
6.12 is,
The 12% is the expected return, and the 60% is and also investment with an expected return of 20%.
oh, got it, okay. So this goes like this. Okay, that's it, okay, got it. And then what happens if the correlation coefficient goes up, what happens to the portfolio variance? Test question. You should already know this. If the correlation coefficient goes up, what happens to the portfolio variance? Goes up. Got it? Are you better off or worse off? If the risk in the portfolio goes up, are you better off or worse off? Worse off. Are you getting diversification when the correlation goes up? Are you getting diversification? No. Okay. And what if this was the covariance on the end? If the covariance goes up, what happens to the variance of the portfolio?
Goes down.
The covariance is over here. Could be the covariance there. Could be the correlation or the covariance. If the covariance goes up, what happens to the risk of the portfolio? Does it go up or down?
Goes up.
Up. Exactly. Are you better off?
Yes.
No. Did you get diversification?
No.
Excellent. That's it. All right, thank you. So I'll take these back from you. Appreciate that if I can get all these back, but I can use them in the next one. Thank you. 1, 6, 7, got it. 8, 9, 10. Thank you. 4, 3, 2, 1. Excellent. You guys want me to go over anything in the exam? Fishing frontier, modern portfolio theory, technical analysis.
We're going over the test and the study group, right?
Yeah, we'll do that too. I was just throwing it out for some people who may not be able to make the, and the 2 review sessions if you had any confusion or anything.
Can you go over those 3 exams we should get, or equations we should get tattooed on us?
Yeah. And then I'll come around and take a look at your homeworks. So the first one is the Fisher equation. Nominal interest rates equals the real rate plus inflation expectations. That's the additive way. So this is the real rate. This is inflation expectations. This is the nominal interest rates. This is the equation you would use to do the yield curve. Maturity, interest rate, or yield to maturity. This is the 1 year, 3 year, 5 year, 10 year, whatever. I1, I2, that's what you're calculating here, using the Fisher equation. And as we talked about earlier, you could also use 1.1 plus the real rate times the 1 plus the inflation rate. You could also do it, this is an additive, simplistic form of the Fisher equation. This is the geometric average to do the Fisher equation. You could use either 2. This one's more accurate. This one's more accurate, but this one's easier to remember. Okay. So when you, hopefully, through my teaching techniques, I will motivate you all to go on to become college professors, which you probably will if you become successful. Those people in their careers that do become successful do go on to be lecturers in universities and their specialization. Or if you're as crazy as I was to do all of that and get a doctorate degree to go teach, then you may join a faculty at some point and do both. or one or the other, or go back and forth. So that's the fishery equation. The second one is the capital asset pricing model.
Sorry, what type of question will you be asked to use that equation?
Which one?
The Fisher equation.
This one's on the exam.
Yeah, I know.
Because it has the yield curve, and then I asked you, to show me the fishery equation, then I asked you to do the, an upward sloping, a flat, and an inverted curve. And then I asked you to write the fishery equation here, and then show me that in an upward sloping curve that the inflation expectation is positive, and a flat curve, the inflation expectation is 0, and then in an inverted curve, the inflation expectation is negative. So that's on the exam.
So it's just to draw it?
Huh?
It's just to draw? Just to draw it?
Yeah, I asked you to give me the three types of curves, and then give me the fishery equation, and tell me what the inflation expectations are, based on an upward sloping, flat, and an inverted curve. And then I asked you to give me the 4 yield curve theories. The inflation, the expectations hypothesis, which is the fishery equation, and then market segmentation, preferred habitat, and liquidity preference, are the 4 theories that we use to be able to predict and analyze the yield curve so that we can forecast growth rates, growth phases in the business cycle, and to forecast imminent recessions.
What's the layout of the test like?
Exactly the same as what we did in the class. If you took notes and we did really good notes, what I'm going to do is I'm going to come in, I'm going to give you the exam in a blue book, exactly like I did before. I'm going to say put everything on the floor, and then you're going to take the exam, okay, from your memory. And then what you'll do after the exam's over, you'll give me the exam. I'll hold on to it until Thursday, and I'll give it back to you. And then you'll go back and No, no multiple choice. No multiple choice. Okay, there's no such thing as multiple choice in the real world unless you're taking the CPA, the CFA, the Series 7 to 66, all of the credentials, all the certifications, will have components of the exam, those credentialing exams and licensing exams. Either portions of it or all of it will be multiple choice depending on the exams that you're taking. So the insurance in the Series 7, and the 66, and the real estate brokers, the agency license are all multiple choice. And when you get into the CPA, the CFA, the level 2s and 3s, you're moving into problem set solutions and case studies, stuff like that. Did that answer your question? Yeah, I'm not a multiple choice person. Yes.
Is it just all of this, everything?
I already gave it to you. We already went over it. So if you took notes, watched the videos, got together, added as much detail as possible into these things, that's what I'm looking for. Being able to write legibly, okay, so that I can read it, and I actually have TAs that have gone through these classes with me, where we sit down and we go through the exams together. That's usually how the exams are graded, CFA and CPA levels. And then we look through them, we talk about it, and then we give comment, and then if you ace the thing, then you're on your way. If you're missing some things, we will tell you where you're making your mistakes or where you're not adding enough detail, and then you can go back to the review videos and take a look at those and slow it down and walk through it and add as much detail. And then what you'll do is for those of you who are still having some challenges, after you submit them back to me and we give you comment, you'll go back, make an attempt to correct, then you come back, you resubmit the sections of the deliverable that need more work. I look through it again, and I progress those that remediated their work, and if there are still people that are struggling from issues or other things, then we need to meet on a one-on-one basis. And then I will walk you through the solutions in more detail so that you learn the material. And if you're still having problems, then you probably need to go talk to your advisor, because I don't know how easy I can make things, you know, if you just kind of follow the process. If you fight the process, you're going to have a hard time. If you don't believe in it, then you're going to have a hard time. If you believe in it and you can see the path, then you're just going to nail it. And my success rate is like 95%. And I usually have maybe 2 or 3 people that just either didn't show up or just they're skateboarding or doing something that's just, finance just isn't in their blood, or they're just not interested, or they just want to pass the course and get on with their life.
Yeah, quick question, sorry. So are you saying like we retake this at some point?
You'll come in, you'll take it, okay, and then I'll give it back to you on Thursday. You have plenty of time to go back, and I really need to spend more time on this section. You know exactly where your weaknesses are. So then you go back and you correct it, nail it for Thursday, then you put the deliverable package together, and then you submit it to me. So the deliverable package has multiple instruments in it to assess your competency and your understanding of the material. So it's not just one assessment, which I think is kind of baloney. It's basically a package of assessments. And then any of the assessments, if there's any deficiencies in any of those, then those are the ones that I'll give back to you ungraded. The other ones will be graded. And then you'll submit those back to me, and then I'll grade them all. So there's really no way that you can get anything less than an A in the class unless you just really make me mad and just, just don't do it, right? And I've had people just say, screw it, I'm not gonna do it. And that just puts me in a bad position. Did that answer your question?
Yeah, makes sense.
And then I'll work with you too. If you're still having confusion on some of the concepts, I'll sit down with you in my office and I'll walk you through the little nuances, that you need to, because it's all in the detail, right? I mean, the number one thing that on every single job description is attention to detail. So if you have that attention to detail, you'll be extremely valuable. And when you're teaching these things, particularly the stuff that I was teaching, it's got to be drawn out and really, it needs to be done really correctly, particularly that portfolio piece. Because again, you may be teaching some of this stuff at some point. I mean, when you get out there, you're going to be asked to do some work, and then you're going to be asked to get up in front of the board and the investment committee and senior level managers, the clients, and walk them through the process and how did you come up with the solution. And you'll probably be drawing on the board or doing a PowerPoint. But you get extra bonus points in these meetings if you can jump up from your seat onto the blackboard or onto the whiteboard, grab one of these things, and start diagramming the solution right there on the spot. I mean, you'll blow them away if you can do that, okay? Any other questions or comments? The other one? CAPM?
We only have 4 minutes, but yeah.
I can do it. So the capital asset pricing model, CAPM. And you saw CAPM over there, you saw CAPM. No, you didn't see it over there, you saw CAPM over there. So this is basically the expected return of the equity, or it's the cost of the equity also. It's the cost of the equity from the firm's perspective, it's the expected return from the investor's perspective. It's the exact same equation. This is equal to the risk-free rate plus the beta times the return on the market minus the risk-free rate. This is the market risk premium. This is called the market price of risk. They don't actually have that in the book. So this is your market risk premium right here. And this equation is your market price of risk. So CAPM is risk-free rate plus beta times return on the market minus the risk-free rate. You need to memorize that. And then the weighted average cost of capital equals the expected cost of the equity times the weight of the equity plus the cost, ID of the debt, times the weight of the debt, and actually this cost here, this one right here, sorry. It's the cost of the debt, or the interest on the debt, or the yield of maturity on the debt, 1 minus the tax rate times the weight of the debt. Because we get to deduct, right? The bond interest payments, we get to deduct those. So we take 1 minus the tax rate. And that's going to give you your weighted average cost of capital. And we're going to use the WACC calculation when we apply those to the where is it? To the present value calculations. We don't have any up here. But when we start doing capital budgeting, we're going to use the WACC as the discount rate. Or we might use the cost of the equity as the discount rate. We're going to use the cost of the debt if we're doing bonds. We're using the cost of the equity. If we're doing securities, or the value of the equity, we use WACC. We use the WACC as the discount rate when we make capital budgeting investment decisions, and I'll walk you through that. And I've designed some technologies around how to memorize, how to make investment decisions for either real estate or the firm level or whatever. Some of the other questions. Or were we out of time? So those are like the three things that you really need to understand. And I'll get into more of that later on. Okay? So I got everything. I got the sign-up sheet here.
Okay, so study session this Sunday, and then Monday and Tuesday we get that
So
exam.
Monday I'll give you another review session if you need it, and then
What time?
we hit it.
I was looking for
It's again 2 to 4.
Right there.
Yeah. Look, come to my office. Whoever shows up, and then we'll go down and talk.
Oh,
We'll lock it.
I'm not sure to be honest.
Hang out luxurious.
Yeah.
I'll take a look at it.
They have one on Monday.
Monday I have class.
Oh, I got it. Bummer.
Thank you. Anybody else want to show me their
I do, yeah. So I changed my resume around, so I added my salary experience there.
We need to work on that.
Okay. Well, okay. There I changed my and then on the memo.
I can do 2.
Oh yeah, sure. On the memo, I can't figure out how to shrink it. Let me shrink it down here. That's the only other thing I can think, but I can do it in a second.
That's okay.
Okay.
No, I didn't pull it out.
I'll see you tomorrow. You have global off.
Oh, great,
Yeah. How's the test in global off? Did you
figure out?
Are you okay with it?
I did the stupidest thing on the crash values. I thought it meant like the amount that you had to pay to crash, not the amount. Thank you. Addition, like you know what I mean? Like it had the total amount plus the crash. And I thought it just meant the crash value. So I kind of screwed up on that, but I got an A.
Well, that's good.
Yeah.
I got a stupid, a mistake actually also. But my extra credit is kind of stupid too.
Yep.
That's the extra credit. Like right after this, and then I'll go over that.
So what's your GPA?
3.8.
So you remember what I mean or something like that?
Let's see. Keeping on the options.
If you need letters or anything.
Thank you. Have a good day.
You got it.
Stay here every time. They watch this game.
Do me a favor and turn off the It's not gonna,